Hello, this is Corner Invest. Is the US economy heading into a recession? So let's talk about it today. So in today's video, I'll be covering mainly three things. Number one, recession fears. Number two, how to protect your portfolio against a recession. And then the last one will be on all the different Mac 7 stocks. So the Atlanta Fed GDP number came out yesterday and it's currently now at around negative 3.7%. Even the goal adjusted one is negative 1.5% already. This clearly shows that there is some form of economic weakness in the general economy today in the US. So the bond market is pricing in a recession slowly as well. We went from a 4.8% 10-year bond yield to around 4.1% already. So that's around a 20% drop from highs already. And if we go back to levels of around 3.8% back in August, then we could definitely see a pricing in of a recession very quickly. So there are a few causes of a recession. Number one, it's tariffs. So tariffs, they lower economic activity. Although they spike up inflation, they will also cause a lower economic activity in the entire world as well as the US, and that could be recessionary. You have tariffs which lead to consumer spending decreasing. So whenever you have tariffs, inflation is normally associated with it. And when there's inflation, consumer sentiments, consumer confidence will start dropping, and that is when you see your consumer spending dropping. So the last portion is Doge. So Doge is actually trying to lower government spending. And when you lower government spending, it will have a direct impact on GDP as well, which could hurt the numbers that we'll see in Q1 this year. So this is the 10 minus 2-year yield curve. And as you can see, every single time we basically uninverted, the US economy went into a recession. So 1980s, 1990s, 2000s, 2008, 2020 as well, and we are currently in sort of like an uninverted phase as well. So if history repeats, then we could definitely be heading into a recession, but honestly, no one knows. So this is job openings. Job openings has been on a decrease since around early 2022 as well. So if we continue seeing a weakening labor market, then this recession could come a lot sooner than everyone thinks it is. So this is what Goldman Sachs says. Goldman Sachs sees Trump tariffs, spiking inflation, stunting growth, and raising recession risk. So Goldman Sachs is they basically increased their inflation forecast to around 3.5% this year, and they view GDP of just 1% and unemployment rate of around 4.5%. So the unemployment rate now is around 4.2%. GDP was around 2.7% last quarter, and inflation is currently at 3.2%. So Goldman Sachs, they see a much weaker economy in terms of inflation as well as the jobs market than initially expected. But the truth about recession is this: no one can predict a recession. More people lose money trying to predict a recession than just riding the entire wave through. So this is the sum rule over here. It was triggered back in August last year. So when we had the Japanese yen carry trade thing in August, the sum rule was triggered. And currently now it is untriggered again. So honestly, no one can predict a recession. All these indicators, they could trigger and then untrigger the next day. So it really doesn't matter. There are a few companies that are extremely highly priced, and if we were to hit into a recession, these stocks will tumble. So this is my warning for all the different stocks that I'm about to talk about. First one is Palantir. So this is Palantir stock. It went up from around $20 to now above $80. And as you can see, the price to earnings ratio is sitting at a whopping 400 times, meaning to say you need 400 years to earn back basically what you're paying for the stock today. That is just crazy. And unless Palantir can continue growing at 40% year on year for the next 10 years, I don't think this valuation justifies the price today. Next one is Tesla. Tesla stock has been flat for the past 3 years or so, and during that time as well, the EPS actually went down. And you have a P ratio that is around 100 times right now. So for me, I think Tesla is extremely simple. It is an avoid. I'll be talking about this one later as well in my Max 7 tier list. But for Tesla, it's a company that is not supported by fundamentals, and when a recession comes, this stock will take a hit. Last one is Apple. It's a stable company, don't get me wrong, but this company over here, its EPS has been flat for a few years already, and yet the valuation has been increasing and increasing over time. Meaning to say that the last few years where Apple has increased in share price was almost 100% due to its increase in its valuation, not so much the increase in the fundamentals. And so when fundamentals detach from reality, fundamentals detach from the actual price, we could see a reversal soon, and that is why I haven't been investing into Apple. So this is a market strategy that you can deploy in different times. So when there's high interest rates and low liquidity, so low liquidity means that the Fed is basically exercising QT, where they're trying to reduce their balance sheet, then you should try and position yourself into defensive stocks. And when there's low interest rates and high liquidity, when the Fed is basically exercising QE, then you should position yourself into high growth stocks. This is how you can try and position and swing your portfolio to hedge against different economic conditions. And there's also another way for you to protect yourself against a recession as well. You could buy into long-term bonds like TLT and TMF, and when a recession comes, the Fed will have to lower interest rates very quickly. And when the Fed lowers interest rates very quickly, your bond yields will drop, and when bond yields drop, your bond prices will skyrocket. But what I'm doing is this. I am not planning to basically switch my portfolio into defensive stocks or buy bonds. What I'm doing is I want to buy high quality compounders that can survive through any sort of economic condition. I'm not planning to switch from growth to defensive. I want high quality stocks that can compound intrinsic value over time. So all these different defensive stocks, most of them, they don't meet my criteria. Similar to bonds as well. Bonds is just speculation. No one knows when a recession comes. And yeah, buying into bonds now, it may be a hedge, but for me, it is not a very viable investment plan that I have for my portfolio today. So volatility is not risk. Volatility provides opportunities to buy. It's fun when stocks go down, and don't get sad when stocks go down. So I'm not planning to swap to defensive to reduce volatility. In fact, I'm using this volatility to add to my positions. Hopefully they go down a lot more so that we could basically just scoop more discounts. So this is the only time for you to sell your high quality compounders. You sell when your investment thesis is wrong, meaning your initial investment thesis was wrong. The fundamentals are deteriorating. So when the company posts weaker fundamentals, this could be a consideration for you to sell as well. When the competitive landscape changes, so for example, like Adobe, Nike. And the last one is when the valuation goes crazy. When the valuation goes to upwards of 50 times earnings, that is when I consider to sell my stocks. But generally, valuation shouldn't be a reason for you to sell your stock. So sentiments follow stock price. So market sentiments, they follow stock price. When the prices go down, everyone starts saying that the stock is terrible, the company is doing worse. And yeah, if you were to just look at it from an objective perspective, it hasn't changed from maybe a few months back when the stock was at all-time highs. So when stocks go down, you need to understand that the future expected returns actually increase. So you should be more aggressive when the stock goes down and not follow the general broad market sentiment. So in this portion, I'll be talking about the Max 7 prices as well as the sentiment. So as you can see, the Max 7 stocks have been hit very hard recently. We have Amazon, Microsoft, Google, all three of them have experienced some sort of sentiment shift ever since the stock price came down. And the markets are basically pricing in the fact that the AI bet won't pay off, the capex spending won't pay off, the depreciation will be a lot more than expected. And yeah, generally the sentiments for these three stocks are terrible right now. So the sentiments follows price, but if you have to look at just the facts, OpenAI revenue tripled. So they are currently having around 333 million to 400 million monthly revenue. So if you have to take this 415 million, multiply that by 12 months, there's around 4.8 billion annual recurring revenue for OpenAI. So for me, I think OpenAI is an incredible company. The AI bet is well and strong. So let's see what happens. So this is Amazon's AWS operating income over the past few years. So as you can see, AWS has been exploding all these years and it has been increasing and increasing all these years. So yeah, again, sentiments follow price. When the stock price goes down, everyone starts neglecting all these things. But the truth and the facts are AWS is growing, Amazon is growing intrinsic value and will continue to do so over the next few years. So now I'll be talking about all your different Max 7 stocks. So your Max 7 stocks are currently down around 13% year to date, and the other 493 stocks, equal weighted, is down around 1.3% this year. So your Max 7 stocks, they're the highest quality stocks, and yet they're down so much more than your other 493 stocks. I don't think this is very fair for your Max 7 stocks. So this is my Max 7 tier list. I have Google on top, followed by Amazon, Microsoft, Meta, Nvidia, Apple, and Tesla. Nvidia is down here because I don't know how sustainable this AI capex spend is, although it is the one that has the highest growth in this list over here. Apple is down here simply because of valuation. Tesla as well. Tesla is basically uninvestable at this price. Meta is here simply because of business quality. It is cheaper than Amazon and Microsoft, but because the business is not as high quality as the other two, that's why it's at C. Microsoft is at B because of the valuation. The valuation is not extremely attractive yet, but for the business quality, it is up there in this Max 7 tier list. Amazon is in A. It is after Google simply because of valuation. And the last one, Google, is up there because it is the one that provides the highest risk to reward right now. So this is Google stock currently trading at around 19 times earnings, 17 times forward earnings, and year to date is down around 16% already. So this is Google's growth. Google has been increasing its revenue, increasing its net income every single year. And the only time we saw a bump was in 2022 when we had recession fears and when the general economy as a whole went into a downturn. So this is Google's valuation today. Google's average PE over the past 5 to 10 years is around 25 times. And let's say it is around 22 times in 5 years from now. So if it has a PE of around 22 times 5 years from now, and assuming a 15% EPS growth, which is definitely more than possible for Google, especially since last year and the last few years, they've experienced 20 to 30% EPS growth. So for Google over here, if it gets a 22 times earnings, it is an 18% CAGR over the next few years. That is market beating. That is incredible for this company. Let's say the stock goes to around a 19 times earnings, that is still a 15% CAGR over the next 5 years. That is a 2x in 5 years. Basically, you double your money every 5 years, and that is what you normally want for all your different companies. Let's say the valuation goes even lower to around 15 times earnings. That is a 10% CAGR over the next 5 years. That is still market returns, even though the PE is at around 15 times. For me, I think Google deserves around a 23 to 24 times earnings, and that is why I remain extremely bullish on this company. Hopefully, the company sells off even more, then we could get a lot more discount and I can get my full position in for Google.